Greetings, fellow investors. The market can be a fickle beast, and sometimes, even the most established companies experience price drops. Such is the case with Johnson & Johnson, a healthcare titan with over 130 years of experience. JNJ stock has seen a dip recently, and some investors are wondering, is this a buying opportunity, or a sign of trouble to come? Today, on Stocks Telegraph, we'll be dissecting JNJ's recent performance and exploring 3 compelling reasons why this dip might be the perfect entry point for long-term investors. So, buckle up and get your metaphorical stethoscopes ready. We're about to examine the health of JNJ stock and see if it's a bargain in disguise. Before we dive in, we want to hear from you. Have you been considering adding JNJ to your portfolio? Or are you hesitant due to the recent stock price decline? Leave a comment below and let us know your thoughts. Now, let's grab our financial charts and see if the numbers behind JNJ paint a healthy picture. In the next segment, we'll explore JNJ's recent financials and see if the fundamentals support a potential upswing. First, let's take a look at the current price. JNJ sits at $148.72. While this might seem concerning after a recent dip, analysts seem to disagree. Their mean target price of $172.96 suggests a potential upside of over 15%, indicating their belief in JNJ's future potential. This strong analyst support is a positive sign for investors seeking long-term value. Now, let's delve deeper. JNJ boasts a healthy gross margin of 68.49%, signifying a company that efficiently converts revenue into profit. This is a strong indicator of financial stability. Furthermore, JNJ's EPS growth over the past year is a staggering 44.66%. This exceptional growth rate suggests a company firing on all cylinders. And if that wasn't enough, JNJ's quarterly earnings year-over-year growth is a mind-blowing 5,231.80%. These figures paint a picture of a company experiencing significant momentum. JNJ's financial health is undeniable. Strong analyst support, impressive profitability margins, and exceptional earnings growth paint a picture of a robust company. But is a recent price dip enough to consider JNJ a compelling investment? JNJ has been turning heads on Wall Street lately, and for good reason. Analyst Darling Cantor Fitzgerald recently reiterated their overweight rating on JNJ, maintaining a price target of a whopping $215. That's a potential upside of over 44%. This overwhelming analyst confidence is a strong indicator of JNJ's future potential. JNJ's first quarter 2024 earnings report was a resounding success. The company not only reported a healthy 2.3% increase in sales but also delivered an impressive 12.4% growth in adjusted earnings per share. This demonstrates a company that's not just maintaining, but actively growing its profitability. To sweeten the deal, JNJ even raised its full-year sales and earnings guidance, showcasing their confidence in continued growth. JNJ's strong track record and positive outlook are a recipe for long-term investor success. Income investors, rejoice! JNJ boasts an unparalleled commitment to dividends. For a staggering 61 consecutive years, JNJ has consistently increased its dividend payout. This unwavering dedication to shareholder rewards is a hallmark of a financially stable and reliable company. Currently, JNJ offers a forward dividend rate of $4.96, translating to a yield of 3.32%. That's a healthy income stream on top of the potential for capital appreciation. Plus, JNJ's historical 5.75% dividend growth rate suggests this income stream is likely to keep flowing and growing for years to come. JNJ presents a compelling case for investors seeking a combination of growth, stability, and income. Strong analyst support, impressive earnings performance, and a commitment to dividends make JNJ a well-rounded investment option. JNJ's recent spin-off of its consumer health business exemplifies their strategic shift towards growth. This growth focus could come at the expense of future dividend increases. Additionally, the looming talcum powder lawsuits pose a significant financial risk. If these legal battles turn out to be costlier than anticipated, JNJ might be forced to reconsider their dividend strategy, potentially even resorting to a cut. While JNJ was once considered an ultra-safe dividend stock, the current situation necessitates a more cautious approach. The potential for a slower dividend growth rate and the uncertainty surrounding the legal battles require careful consideration. Before adding JNJ to your portfolio, carefully consider your risk tolerance and investment goals. If you prioritize a high and consistent dividend stream, JNJ might not be the best fit at the moment. However, if you're looking for a well-rounded healthcare company with solid growth potential and a commitment to shareholder rewards, JNJ could be a strategic addition, especially considering the current price dip. Ultimately, the decision to invest in JNJ rests with you. We've provided the information and analysis to help you make an informed choice. Remember, thorough due diligence is crucial. Research JNJ's future growth plans, the potential impact of the lawsuits, and how these factors might influence the company's dividend policy. Let us know your thoughts in the comments below. Would you consider JNJ a solid investment despite the potential challenges? What other factors are you considering? Thanks for joining us on Stocks Telegraph. If you enjoyed this analysis, don't forget to like and subscribe for more in-depth explorations of exciting investment opportunities. Until next time, happy hunting!